Hello everybody, welcome to this Let's Learn Futures webinar series brought to you by Bursa Malaysia and managed by our company LifeChamp. So today we are very excited to see you all again on this futures webinar. Now today's topic is on how to trade with candlestick charts like a pro, and we have more than 1,700 people registered for this webinar. So if you're online right now, you are very lucky and very early because we believe that it will be full house very soon. So today we are gonna do a study into how do we read candlestick chart and how do we identify candlestick patterns on the chart and how do we make trading decisions on this. And today we got a speaker who is very experienced in this field to share a view about candlestick patterns. Now, before we begin, as usual, disclaimer, whatever we share on this webinar is only for educational purpose. In no way that we give any recommendation to buy or sell any companies or long or short any futures contract. So if you decide to do any financial decisions or investment decision, you do it at your own risk. Now, these are the remaining Bursa Malaysia derivative sponsored webinar for the rest of the years. We have next Thursday, we're going to talk about risk and money management strategy for money maximizing trading results by David Lowe. And until December 17th, this is the remaining session. Just remember, if you want to watch the upgrade your knowledge in futures, then reserve your Thursday evening with us. Okay, mainly it's Thursday. So without further ado, let me introduce our speaker today. Yeah, she is the CEO of Sigma Wealth Sdn Bhd. She is a certified financial planner and a licensed financial planner with Securities Commission's CMSL license and Bank Negara licensed financial advisor representative. She has been in the training industry for more than 20 years. She is also the course facilitator for Financial Planning Association Malaysia CP courses, and she has published 5 investment and financial planning books. You can find them at the major bookstore. Okay, and in addition, she's also a certified chartist, okay, CFTE in Malaysia, and a member of the Society of Technical Analysis in UK. And she's none other than Pauline Yong. Okay, Pauline, welcome to our webinar today. We are very excited to have you online.
Hi, good evening, everyone. I'm honored to be here.
Today, the session received overwhelming response. So yeah, so are you ready to rock the house?
Yeah, hopefully I can teach something or share something that people will benefit from it.
All right, cool. So I'm just make you a presenter. So yeah, you can take it away, Pauline.
Okay, sure. So today's we are going to talk about candlestick chart pattern. And before I go into this candlestick chart pattern, let me give you some background, because when we are talking about technical analysis, very often we focus on one. Because in technical analysis, you have so many fields. Like you have candlestick, you have Elliott wave, you have Fibonacci, you have cycle analysis. You have so many. Then you get confused, like so many things to learn. How should I start? What is the first step? Like, you know, you got too overcrowded in your mind. So I just want to give you a brief background of what is the right steps towards this technical analysis. For technical analysis, right, I usually look at the whole thing as you must have looking at this as you can look at it as a long-term view or even a short-term view. A lot of time people thought that this one is actually for short-term trading. But actually, for technical analysis, you can have it short-term, medium-term, and even long-term. Okay, so you can actually, the time frame is you must set the time frame, and then from there, then you look at the individual chart that suits that kind of a time frame. So the very basic things that you need to cover is trend line analysis. So in a chart, when you take out the chart, right, the very first thing that you need to draw is the trend lines. And there are 3 trend lines that you need to set the background before we go into Elliott wave or Fibonacci or candlesticks or whatever. So these are the three basics. Okay, so the first one is the moving average. So usually I would use the 20 days moving average and the 200-day moving average. So the very first thing I will tick, and then I will draw that 200-day and the 20-day into the chart first. Then number two, I will draw the support and resistance line, the horizontal support and resistance line, which means in the chart, right, you will have to start to draw like the horizontal trend line, okay, horizontal trend line. And this horizontal trend line, you have to look from left to right across the chart. Maybe you can from 3 years all the way to 5 years, the big picture, and then you can go on to the small picture. So you look at the macro first, and then look at the micro, and then you look at what are the price level that have a lot of price action, like a turning point. So the top is a turning point, and then the bottom is also a turning point. So these are the points whereby you can draw horizontal trend line to separate your diagram. So usually I will prefer identical, like a equal distance kind of a trend line. So that means if it's a KLCI index, maybe it's 20 points, 20 points, 20 points, you separate by the trend line. So these are the horizontal lines. And number three will be the trend lines. And this trend line will be the slanting trend line. Okay, because just now I was talking about the horizontal, right? Then that was the support and resistance. So then the third one is the trend line that is actually the price movement, the current price movement. You're looking at the current trend of the current price movement. So then you have to draw. So for example, this particular chart is going on the uptrend or downtrend. So that's a basic thing you need to know. Is it uptrend or downtrend? Okay, so you draw according to the current situation there. Is it uptrend or it's a downtrend? Okay, so these three trend lines form the basic foundation of technical analysis. Once you have these three in place, then you start to look at candlestick chart pattern, you look at the Fibonacci, you look at a lot other things, or even technical indicators. Okay, so the background is like this, so you must have that. Okay, then you look into the candlesticks. Now among these patterns, like you have this chart pattern, you have this candlestick, you have Fibonacci and all this, right? I also rank them accordingly. So among these, right, chart pattern is number one. It's really the number one. So the basic is the trend lines. Okay, so on top of that basic, it's like you are building a building. You need a foundation. You need to lay a foundation. So after you lay the foundation with the trend line, then you start to build the on top of it, and then so that the foundation will get stronger and stronger. So the next layer will be the chart pattern. The chart pattern is very, very important among these. Okay, the chart pattern is very important, and then followed by the candlestick. Okay, the followed by this candlestick, cycle analysis, Fibonacci, all these will be together. I will see that they are the same rank, and then they are the next level. Okay, so the candlestick, Fibonacci, Elliott wave, and cycle analysis, and all these will be on a higher level, which means that these are on the same part. Okay, same part. All right. So back to this candlestick. Okay, so you can see that what is a candlestick for the newcomers into the technical analysis, right? Candlestick is a chart that are often used by technical analysis people. In the past, they use a bar chart. Okay, a bar chart is very similar to this candlestick. So let me explain. So each of these candlestick, right, represent one time frame. So if you are looking at a daily chart, then one candlestick represents 1 day's price movement. Okay, if you are looking at a 5 minutes chart, so one candlestick represents a 5-minute kind of a price action. Okay, so that candlestick will represent the individual time frame. Okay, so it represents 1 day. In this case, it's a daily chart, so it represents 1 day's worth of price data about the stock. So it usually, if you look at it, either you have a black color or a white color. So in certain charting software, you have red or green. Okay, so the white color and the green color represent bullish. The black color or the red color represent bearish. Okay, so the very first thing, they use color to distinguish whether it's bullish or bearish. So it's very easy to look at candlestick chart pattern. So at one glance, if you see that the whole chart is dominating with black color candlestick, okay, so you know that it's a bearish trend. And then at one glance, it's all majority are white colors, then it will be the bullish trend. Okay. Now, then let me explain. So you have this opening. Okay, so if you look at it, it's a white candlestick, white bar. So it means that you open low and you close high. So then you have a white color or bullish bar. Okay, bullish bar over here or bullish candle over here. So open here and then close high. So open low, close high, then it's a bullish. It's an update. It's an update for that day. Okay, so buyers is in control. So the tails are actually that day's highest point that it went, and then the lowest point that it went. So the tails are the intraday high and the intraday low. Okay, so you can have like the closing is the highest of the day. You can have it. So that means you do not see any tail on top. So it means that you close at the top, the highest price of that day. Okay. And then similarly for this black color candlestick, you open high and you close low. So that's why you have a black color candlestick. Open high and close low. So and then this is the day high. So you open and then you went all the way up and then you go all the way down because it was very bearish. It went all the way down and then it went so low and then it rebounded. And then at the time that it was the closing time, maybe 5 p.m., then the price closed at this level. Okay, so this is the it tells you what is my opening price and what is my closing price and what is my day high and what is my day low. So one candlestick can tell you so many information. So it's like very informative. This chart is very informative rather than the line chart. The line chart doesn't tell you what is the day high or the day low. It's just a line, and the line is represent the closing price only. So you only know what is the closing price. You do not know on that day before the price closed on that price what happened. Did it went all the way up or did it went all the way down? We do not know. So that's a line chart. So with this candlestick, we have all this information. So it's very powerful. So there are only two groups of people in the stock market. They are buyers and sellers. So we want to find which group is in control of the price action, and we can use the candles to figure that out. So basically, you have a wide range candle. That means it's a tall candlestick, and you have a narrow range candle. Okay, so these two represent different psychology behind it. So the wide range candle states that there is high volatility. That means interest in the stock. So that means if you have a tall candlestick, so that means the price actually went all the way up and then it went all the way down and then it's like fluctuate within this range, maybe 50 cents or something. Okay, so that means the price actually went to a very high price, and then it also went to a low price. So the daily fluctuation is quite a big range. Okay, maybe 50 cents or 1 ringgit or something. So it's a big range there. Then the narrow range candle that is representing low volatility. So that means that day maybe it only moved like 10 cents. Okay, the price is maybe 10 ringgit. So it only moved like 10 cents. Okay, which is quite a lot also. Or maybe it's move 5 cents or 3 cents. So that means that the price action is very limited. So maybe people are not so interested in the stock. Okay, the buying and selling volume maybe is not that high, but there are a lot of, because actually for that wide range candle or narrow range candle, you actually need to look at the volume. Okay, you need to look at the volume. The candlestick is just a candlestick. It tells you the price action. But what usually the professional chartists will actually look is looking at the volume. By looking at the volume, right, it really gives you the interest of the stock, whether it is interested in the stock or not interested. It's the volume that counts. Okay, so always remember the volume tells you whether the people are interested in the stock or not. And then if let's say you can have a short narrow candlestick, but the volume can be very high, that means a lot of people are transacted on that day. Okay, so so the volume is very important. Okay, so if we know that stock tends to move in the direction of wide range candles, we can look to the left. The chart look to the left means the historical action, because when we are moving to the right, we are looking at the future. So this is the x-axis. Okay, so it's like going to the right is the future time frame, and then going to the left is the past historical price action. So when you look at the left, right, so you can see what is the interest of the buyers and the sellers by looking at whether you have a lot of tall white candles, or you have a lot of black tall black candles. Okay, so that gives you a lot of information. If you see a lot of wide range candles, that means what? That means it's very bullish. Okay, if that chart has a lot of wide range black color candlesticks, so that means it's actually very bearish. Okay, so we want to know if there is interest in the stock and if it's being accumulated or distributed by the institutional traders. Okay. So the narrow range candle imply low volatility. So this is a period of time where there is very little interest, and however, these narrow range candles often lead to reversal because low volatility leads to high volatility, and high volatility leads to low volatility. So what it means that sometimes you see that the price action is that sometimes it is very low volatility. That means narrow. Okay, narrow candlestick. So this narrow candlestick can means especially when there's high volume, can means that it could be it's just the preclude of that the storm is going to happen. Okay, so the low volatility is just a signal to you that the storm is going to happen in the future. Okay, so it's like calm before the storm. It's like a calm situation before the stormy weather. Okay, so that's low narrow range candle. When you see those especially doji or small narrow, and then that means that could be the bigger price action is ahead in this situation. Okay, so then you see that the price move in the direction of a long candles. Okay, move in direction. So if you see wide range candle, so it is an uptrend. So if you see a lot of down black long candles, it's a downtrend. Okay, so this straight away tells you uptrend or downtrend. But of course, like what I say, the very first three things that you need to do to put up a 20-day and a 200-day moving average, and then you draw horizontal support and resistance line like this one. You see that there's a peak here, and then so when you draw this, maybe you'll match this part here, so it's a valid horizontal support line here. Then you will see another one. There's a pointed place here, and then maybe you can draw over another line, and then over here you draw. Okay, and the bottom here you draw. The top also you need to draw. Okay, so you need to, and this one is only like 4 months, so it's not enough. You got to have like 3 years so that you can draw horizontal line better. Okay, 3 years chart, and then after you draw the horizontal line, then you draw the trend line. So this trend line you draw on top here. So it is a upward sloping trend line. So this trend is an upward sloping. Okay, you can even draw a channel by joining these two peak and then draw another trend line. So it's an upward sloping channel line here. Okay, then you look at the candlestick, because the candlestick usually people spot the reversal pattern using the candlestick. but you don't focus too much on the candlestick and then you neglected the whole big picture. The whole big picture maybe is a bigger chart pattern behind it. You didn't see it. You just look at the small little candle, because a lot of people, they may become too micro and then just focus on the candlesticks, and then they forget about the big whole thing behind, which is the big chart pattern behind it. Okay, so which is very important. So you always have to look at the big macro view, then you zoom into the micro. So single chart pattern. So let me introduce a few interesting but important candlestick chart patterns. So the first one, they call it the king of the candlestick, which is this Marubozu. Okay, Marubozu is a Japanese word. So all this is actually originated from Japan. So all the names here are Japanese words. So this is the king of that candlestick, which means that you open low and then you close high. And this one, you open high and then you close low. So there's no intraday. The intraday low is the opening price. The intraday high is the closing price. So you don't see any shadow, no tail, no shadow here. Okay, so this is the Marubozu. Then this one is called a spinning top. So spinning tops will have longer tails. So usually when we look at the candlestick with long tails, it shows that you just look at, you don't need to memorize the names. I don't like to memorize the names. I just like to understand the psychology behind it. So for example, you look at this particular chart. So you have open from here, you open from here, and then maybe that day you go all the way down, and then you go all the way up, and then finally you close very near to the opening price. Okay, you back to here, very near the opening price. So then you form a small white narrow body here, but you with a long tail. Okay, so this tells you what the psychology. The psychology is that the people are kind of undecided, isn't it? Because you see, the people actually move all the way down, and then it move all the way up, and then finally it moved to the back to the original place. So that means that people are actually not sure where the direction is. They do not have a clear direction. Like this one, they have a clear direction. You open low and then you close high. So it's a bullish day, so you close high. It's a clear situation. But over here, okay, over here, the price swing all the way down, and then it went all the way up, and then it closed back to the original position. So it's like the psychology behind it shows that people are not sure what's the trend. They are not sure. Okay, so it's undecided. So this long tails usually signals that it's undecided, and then maybe there's possible trend reversal, because whatever the original trend, okay, or whether it's an uptrend or downtrend, if you see something like that, it could be a trend reversal. Okay, it could be. And among these candlesticks, right, then these candlesticks will have like strength. Like for example, this candlestick will give you a strong, very strong reversal signal. And then when you see that this candlestick, although it's also a reversal signal, but this candlestick have a weaker reversal signals to you. So then you need to recognize what kind of candlesticks, right, will send you a very strong reversal signals, and then which one is the weaker one. Then you just probably, you know, don't pay too much of attention. You pay attention to the strong reversal candlestick pattern. So these, the things that I introduced today, only a few ones, but these are the common ones. That means, because technical analysis is like this, the more people familiar and they recognize it, then they will act on it. Okay, they will see that, oh, if everybody know that this is a shooting star, then of course everybody will act on it. Okay, so certain pattern, not many people are familiar, so maybe, you know, they may not act so much, but those familiar ones, like very famous one, those are the pattern that people will act on it, and these are the strong reversal candlestick pattern. Okay, so the next one is this long shadow. So but this long shadow is very long on the upper side there. So psychology, it tells you what, these two are long. If I can see your answer, but I think I can't see your answer. But if I were to ask you, these two, right, which one will give you a more bearish kind of a psychology behind it? Okay, never mind. So if you can tell me the answer, I can hear your answer. So I can see that maybe some of you know the answer. So you see, this psychology, the price open here and then close here. Okay, open here and close here, and then it went all the way up, and then it went all the way down. So all the way up and then all the way down here. Okay, so you have this selling pressure. Okay, over here, the price went to a very low point on the day. Okay, at the lowest point here. Let's say this Maybank open at 750, went all the way down to 7 ringgit. Okay, and then it went all the way up to 760. So probably they opened at 750, went to 760, and then went down to 7. Okay, it was a very bad day. But then suddenly, before the closing, it went all the way up to back to almost the original, around 760. Okay, so then what tells you about the psychology? So it went all the way down to 7, but then before the closing, right, it went all the way up to 760, about the same price of the opening price. So does this gives you a signal that, or the psychology or the feeling that this particular day, this stock is actually have the support? Okay, it has the support. Okay, and then this particular day, and then this particular stock has the selling pressure, because you went all the way up and then you close all the way down. Your highest and your closing price, there's a big gap. Okay, and then it was a lot of selling pressure here. So usually when we look at it, no matter what's the name, you don't try to remember the name. You just look at the tail. The longer the tail on top, right, it means that selling pressure is a lot. It means a lot of people sell down. You shoot all the way up and then it went all the way down. So selling pressure a lot. And then for this kind of a long tail at the bottom, it shows support sign. Okay, a lot of support behind it. So which is good. Okay, which is bullish. And this is bearish. Okay.
Actually, many people also pick, the black one, which is the first one. So they can respond to me, but you can't see it. So let me later you can ask a question. Okay. I will help you to tell you what answer they pick more.
Okay, so that means the group of people are more experienced one. Maybe I can go a bit faster here. Okay, I'll try. Okay, I'll cater for the beginners also. Okay, so over here, this is my favorite. Okay, I'm not sure how many of you out there, but this one is my favorite, because for the equity market, right, we can only long, we cannot short. Okay, at least not for now, until December. So if you can't short, you can only look for long. That means you can only look for buy opportunity. Now this is a perfect buy opportunity that I always like. So this is called a hammer. So in a downtrend, and then you look at the downtrend, and then you see this hammer with a very long tail, like I said, right, with a long tail at the bottom, it means strong support. So that means this turnaround is going to be a strong signal. Okay, this trend reversal is a strong signal. Okay, so which is good, and then it will be reversed, trend reversal, as a strong trend reversal sign here. So this hammer, the meaning behind it is that formation is formed by either a black or white small body candle with no upper shadow. Okay, and then there's a strong all the support you can find here with the tail, and then this form must be present among the downtrend when it is expected to see low. Okay, so this one, that means that you must have a downtrend. Okay, the downtrend, and then followed by this, not the up one. If on top you see this is totally different. Okay, have to be downtrend, then you see this, then it's good. Okay, this is the hanging man. So this is also the same pattern, right? But now this hammer shape, right, is happening on the top. That means at the top of the chart pattern. Okay, see if I can show you the this one. Can you see? Can you see? Can, right? So you see,
yes, investing.com, right? Yes, can see.
Investing.com. Yeah, I'm showing you the investing.com. You see this Hatalega on this
the browser, then
expand. Okay.
Yeah.
Clearer?
Yes. Yeah, it's bigger lah.
Bigger, but still the chart is not very big. Okay, so you see this that day, which day? September something. Okay, that day this thing happened. So it's a Hatalega. So on that day, a lot of the glove stock also have this, and actually the subsequent day was a disaster for a lot of glove stocks. But anyway, you saw this or not? This one is called the hanging man. Okay, so when you see this hanging man on the top of the chart, it's a signal. It's a reversal, trend reversal. So that means that the trend will reverse from the previous one. So previous was an uptrend, it will be reversed, and then it become a downtrend. Okay, so it become a downtrend. So this thing happened, and this candlestick is very huge. Okay, as the price volatility is huge, and the volume is tremendous. Okay, on that day. Okay. Where is my escape? Okay, I'm trying to get back to my slide. I try to escape, but it cannot.
You can switch the screen.
Here.
Yeah, this is the one. You just minimize it. The green button, the green button.
The green button.
Yeah.
Okay.
You're not familiar with Mac,
I'm not used to the Mac.
Oh, okay. Okay,
back to here now. Okay. So we are now here. Okay. So this one is a warning sign, trend reversal. It's good when it is at the bottom, not good when it's on the top. Okay. So that means reversing. So it's formed by this small body and then with a long tail. And so that means you have although you have a lot of support here, but then when it's formed at the top there, it means it's bad. Okay. So actually, for the top, right, you also have another one. So I usually like to compare this one with the shooting star. This one, shooting star, also found on the top. But these two, right, definitely one will give you a stronger sell signal. Excuse me, than the other one. Okay, this one because it has a long tail. So that means there's a strong support here. But it's just that it happened at the top. So that's why it's a reversal pattern. But if you to see this one is really, really powerful, more powerful than this one. Okay, so I repeat, for the candlestick, right, it has strength, like 1 star, 2 star, 3 star kind of a strength. So this one probably is about 2 stars, but this one is 3 star strength of the reversal. Okay, so this is the shooting star. So the chances of reversing is higher. So this is a writing. So it's formed on a very high, long upper shadow. So that means selling pressure is very high. So it's a very powerful bearish reversal sign. Okay, then you have another one, which is like something like a shooting star, but this one happened at the bottom. So this one we call the inverted hammer. So just now, we see that when it happened in the bottom, just now the hammer, right? The hammer happened at the bottom. It was my favorite, which means that it will sure reverse. But if I were to see this one is less powerful because of the long tail on top. Okay, this long tail on top signify the selling pressure, so it's not that powerful because when you are reversing from bearish to bullish, you need support. Okay, you need to have a strong support so that you can bounce and then you can go all the way up. But this one, you have a large selling pressure, so it's not so convincing, but still it's a reversal chart pattern. It's like a 2 star kind of a reversal chart pattern in terms of the strength. Okay, then this is the writing. Okay, next, the Doji. Doji is a candlestick pattern whereby it tells you indecisiveness, not sure, unsure, okay, indecisiveness. So over here you can see that you open at this particular price, and then you went that day, you went all the way up, you went all the way down, and then finally you close back at the original pricing. So that means what? That means this whole day, right, people are like ding ding dong dong, do not know where to go. Okay, you go all the way down, and then you see that it's not right, it has to be up, then you go all the way up, and then finally then you find that it's not right, you have to go all the way back to the original position, back to square one. So that means the whole day is like you do not know where the trend is, you are not decided. So this kind of a situation, the psychology behind it, right, it tells you that this trend is in query. That means people are trying to in doubt. Okay, if it's an uptrend, then that means this uptrend is in doubt. If it's a downtrend, that means this downtrend is in doubt. Okay, so it's also a trend reversal. Okay, so this trend reversal, how strong is the strength? I would say it's about 2 star. Okay, it's about 2 star kind of a strength. Okay, then you have this Doji. This Doji tells you the market is uncertain, but then although both are uncertain, but then this one has a more selling pressure and this one has a more buying support. Okay, so you look at the tails now, where the tail, whether you have a long up tail or long over here. So if let's say it's the same length, so that means it's uncertain. Okay, so whenever you see Doji, right, whether you have a long or at the bottom, right, it's all uncertain. It's just that this uncertainty, is it towards the bullish side or towards the bearish side? If you have a long tail at the top there, it's a bearish, that means selling pressure. So always remember a large long tail on the top is selling pressure. Okay, so if it's at the bottom, it's support. Okay, so this one support, this one selling. So this is more bearish than this one. Okay, so you just understand the psychology. Don't bother to memorize the name. So I never bother to memorize the name. It's not important, the name. The important is to recognize this pattern and then understand the psychology behind it. That's the most important. Okay, it's not like we're going for an exam. If it's an exam, people, you are tested, then you have to memorize the names. And for your information, there are over 200 patterns in terms of the Doji, 200. So you wouldn't be able to memorize all of them. 2 or more candlesticks. So you have a bullish candlestick pattern, and this is the bullish engulfing. Okay, so this bullish engulfing is quite powerful. Okay, so it's a reversal as well. So when you see this, or even in the continuation, you can also see this. Okay, either a reversal or continuation, you can see this. So this usually when you see a large white body that engulfing the previous bearish day, so that means it's going to be bullish. Okay, but must have a volume lah. So the volume will to confirm this bullishness. The chart pattern is itself, it means nothing, and unless you see the volume, the volume acts as a confirmation. All right, the volume acts as a confirmation. If without the volume, it's like you know, you are like 50% for that part. So formation is a small body over here, and then followed by this large body, and this large body is engulfing this one. Okay, so it completes this total. That means it's very bullish. You see how bullish it is. I just tell you the psychology behind it. So this one, previous day it opened high and then closed low, right? Open high and then closed low. And then the next day, right, it get down. Okay, so that means you start from this level because it's from here to all the way up. So you get down. Get down means bearish, but then it went all the way up past this whole body. So that means it's a very bullish day. Okay, it reverses this get down negative, and then it went all the way up and then engulfed the whole of this candlestick. So this one is a very powerful trend reversal. Okay, if it's at the bottom, if you find it. Okay, or if it's a continuation, it's a continuing. Okay, it's a bullish continuing. Okay, Then this one is called the Bullish Harami. Harami means pregnant. So does it look like a pregnant lady? Okay, it looks like a pregnant lady. So so it's called the Bullish Harami. So this one with a very bearish long black candle, and then followed by a small white candle in the middle. So we call it the Bullish Harami. And this white candle gives you the bullishness about this particular situation. Okay. And people usually, sometimes you will see that you do not have a white body here. Sometimes you have a cross here, and then that one is called the Harami cross. Harami cross, it means that the second day, right, it's not a white body but a cross. Okay, Doji is a Doji sign. So this also bullish. Okay, also bullish. And then who is more bullish? Is it the Harami bullish Harami more bullish, or the Harami cross is more bullish? Actually, according to the research, right, they said that the bullish cross is more powerful, the more strength. However, from my past looking at the chart, I see them as about the same. Okay, I wouldn't see that which one is more powerful, but both of them have the bullishness in them. Okay, both also very bullish. Okay, especially when you find this at the bottom of the chart, like after a prolonged or maybe subsequent down days, and then you see this, and then this will actually confirm with the third candlestick. After you see this, right, the third day usually is a white candlestick over here. Maybe it's a gap up or something. Okay, then it's very bullish. Okay, so however, if let's say you see this, right, but the third day is a small price action, so that means weak. Okay, it's weak. So after you see this, you have to see the third day, what's happening. Okay, so if you see a gap up, that's good. Okay, if after you see this bullish reversal, also no gap up, but you know, a small kind of a pattern, it means that still lack of the strength. Okay, still lack of the strength. So all these are psychology behind it. As long as you understand, it's very useful. And then this one is called the piercing line. So this piercing line is actually you have a black day, that means a bearish candlestick previous day, and the next day you gap down. Okay, you gap down means continue to be bearish, but it went all the way up and then it closed at the above the half of the body of the previous day. It didn't go all the way up there. If you went all the way up, it's a bullish engulfing, but it didn't. It stopped halfway, but it's still considered bullish. Okay, it's called piercing line. And so this bullish compared to the engulfing, of course, this one is weaker because it's only up to here. The bullish one, the engulfing will be much stronger. Okay, so if you're comparing the stars, this one 2 stars, and then the bullish engulfing will be 3-star strength. Okay, so you look at the relative strength, okay, of these kind of patterns. And this one is called the morning star. The morning star is with a bearish candlestick, and then you gap down, you close. Okay, however, you have a narrow range, a short candlestick, but then on the third day there's a large white candlestick. So this actually confirm bullish. Okay, this white candle actually confirm this bullishness, so it's called the morning star. Okay, so even if you do not remember this morning star, but you look at it, okay, you have a gap down, and then you close the second day with a small white candlestick, and then the third day you have a large candlestick, so it's bullish. Now this one is called 3 white soldier. It's very simple. Simply 3 consecutive up days. Okay, 3 consecutive up days. If you have 3 large consecutive up days, you have to see these 3 consecutive up days are how large are the candles. If this candlestick are very large, right, that means the price has already gone up too high. Okay, if let's say this one all the way up there, that means it's already too high. So the next day, the 4th day, right, it may not be bullish, it may be profit taking. So you have to be careful about this 3 white soldier. And sometimes it may be running like overbought, and then the 4th day it's not you know, bullish, but actually it's a profit-taking day, so have to be careful. But no matter what, these three white soldier indicate bullish. Okay, so maybe the fourth day is a profit taking, and then maybe the fifth day you pick up again. So it means it's a bullish. Okay. Okay. Next, the bearish. Bearish is actually the opposite of the bullish. So this is actually the opposite. Remember just now we saw the second candlestick is a very huge white candlestick, right? Then that's called the bullish engulfing, right? But this one is the white, large, wide range and large black color candlestick. So this one is called the bearish. It's very bearish day. The whole day it get up and then it went all the way down and then closed very low. So this whole day was a down day, and it was a very bad day indeed because it went all the way down. It get up actually initially it get up, but it closed all the way down. So very bad situation. Okay, so this kind of a bearish engulfing will be like 3-star kind of a strength. Okay, 3-star. And then this is a bearish Harami. Bearish Harami is a pregnant lady. Okay, but this pregnant lady is bearish because you have a black color candlestick in the next day. Okay, and this black color is actually within the length of this. You see, the length of the white candle is within it. So it's like the tummy, the pregnant lady. So it's a bearish Harami. So this bearish Harami is very bearish, okay? But in terms of this engulfing, this is more bearish than this one. But however, I look at the Malaysia, Bursa Malaysia, right? Usually when you see bearish Harami, right, it's quite responsive. That means whenever you see this, the next day is actually a reversal. Okay, it's usually quite responsive. Dark cloud cover. Dark cloud cover is having a large black color candlestick, bearish candlestick the next day. So it's like a dark cloud covering this one. So it's bearish. Okay. Then this one is evening star. So this one is like you get up. The second day you still saw a good situation, but the next third day, right, you saw it's actually a small gap down, and then it went all the way down. Okay, so it's an evening star. Okay, 3 black crows. Now 3 black crows is the opposite of the 3 white soldier, and when you see these 3 black crows, also same thing. If you see very large black crows, that means oversold already, and then if you want to short the market, it's very dangerous. You have to be careful. Okay, you have to see that it's already oversold. So maybe the fourth day is profit taking, rebounds. Okay, so but nevertheless, 3 black crows is bad. Okay, it's bearish. Okay. Okay. So if you have a question, you write down, and then later you can ask me. Okay, so I'm just going to go through this small quiz here. So among these 1, 2, 3, 4, 5, these 5 candlestick, which ones are the bullish pattern? Which ones? Okay.
Okay.
In fact, all these are bullish.
All right.
Okay. This one is not a quiz yet. Okay. My quiz is another slide. Sorry. This one is actually grouping them together. Okay. This one is a bullish candlestick. Okay. I grouped them together. And then this one is the bearish candlestick. So I grouped them together. Okay. My next slide is this one is the quiz. Okay. This one is my quiz. Okay. So which ones are bullish? Which ones are bullish? Okay. So if you to look at it, this is number 1, number 2, number 3, and number 4. Okay, you have 1, 2, 3, 4. You can give me more than one answer lah. Okay, which ones, right? You can give me more than one answer. See who can type the right answer. Are we seeing the people typing the answer there?
Yeah, there are more answers than my eyes can meet up with the speed.
Okay, so roughly what are the numbers that you can see?
Yeah, all number also got. Majority pick 2. Second
2,
one
yeah.
we have 4. we have
4, yes, 2 and 4, right?
4.
Mm.
Yeah.
2 and 4 are the most answers, right?
Yeah, some say 1 and 3 also got lah. Okay, but majority pick 2 and then followed by 4.
Okay, very good. So the 2 and the 4 are the correct answer. Okay, and then if let's say you want to say this doji as a bullish, also can. It's like a trend reversal. It's although it's not like a bullish as the term is bullish, but it's like a trend reversal. So if it's a downtrend, then if you see this one, then maybe it's a bullish sign. Okay, so it can be bullish or can be bearish, but it's a trend reversal sign. But these two are definitely, 2 and 4 are definitely. 2 and 4 are definitely, this is the downtrend, and then when you see a downtrend then followed by this one, it's definitely a bullish, and then for this one it's a bearish engulfing. So this is bearish. Okay, now which ones are bearish? You can give me more than one answer. Which ones are bearish?
Also 1, 2, 3, 4.
Also 1, 2, 3, 4. Anybody? Okay, what are the numbers that you see that are coming out?
Also, there are also so many. Okay,
the most common number.
The most common answer is 1. No, actually, the most common answer is 1, 2, 3.
Yes, 1, 2, 3 is correct. Okay, so the first one is called the 3 black crow, so it's bearish. And then this one is like when you are in the uptrend, so you saw this shooting star on top, so that's bearish. And then this one is a dark cloud cover, so the next day you have a large bearish candlestick overshadowing the previous one, so it's a bearish sign. And then this one is called the bullish harami. Okay, so these are the patterns. So you recognize the pattern first. Okay, so after you recognize the pattern, then we can apply. So we can either apply, see what software you have. If you have the Bursa station, then you just take out the Bursa station. If you do not have, then you can go to the investing.com. Okay, so both I also have. So for this one, the application. So for this one, you look at it. Okay, you look at it, and then the first thing usually you have to do what? Draw the 20 days and a 200-day moving average. So this one is a moving average line here. Okay, to show the support and resistance. So this one is a daily chart. Okay, it's a daily chart, and then I use a 8-day because it's a consider rather short term. Okay, I use a 8-day. You can have 20-day or 200-day. Okay, 20-day and 200-day is a must. Okay, and then followed by draw trend line. So see if I can draw this trend line. So top, did you see the top here? So you have to draw a horizontal trend line here. You use the horizontal so that it will run across horizontally. Okay, so you can use the horizontal trend line then to make it horizontal, and then you identify, okay, I have this, I have here, so there's some congestion here, so maybe over here I can also draw another line. Okay, so the lines are actually when you see some congestion like a lot of price action like that, then you can draw. Then you see there's one over here, there's one like, you know, a turning point over here. So over here you can also draw another line. So all this horizontal line, it has to be across from left to right across. Okay, it's not like this one, because I do not have that horizontal line, so I use this drawing. But actually you have to use cross all the way, because this horizontal line, right, when you look back, it could be the past support and resistance as well. So you see here, so you draw lines. Okay, you draw lines. So among the lines, right, usually I will try to draw like a proportional lines. Okay, proportional, so that you can divide this into proportional section. And then these are the support and resistance. Okay, and then if you can calculate like what's the price range difference, like using this minus this one so that you can get the price difference, and then see whether this price difference is about the same, and then this subsequently, then you can draw the next price difference that will match this difference. Okay, so most likely is I will draw like that. Okay, so as you can see, it's almost proportional. Okay, so this is number two. Number one is to give the moving average line. Number two is to draw the horizontal line. And then number three, you draw the trend line, the slanting trend line, the current one. This part is the current one, and these are the past. Okay, so you can draw this trend line. Not straight enough, but it has to be a straight line. Okay, so that means this particular chart pattern is on the bullish trend line, and then if you want, you can even draw a channel. Okay, because it's not very straight, because the channel, this one's supposed to here. Okay, so this one's supposed to tell you the support and resistance within that trend. Also, you see this whole diagram, you have the support and resistance. Okay, when you see the macro picture, but when you see the micro within this few days or few weeks, you must also see that this channel line, right? Somehow the price action reacts very well with the channel. You see, this is a resistance, then it will not pass the resistance, then it bounce back. So it's like moving within that channel. Okay, so it's moving within. You can also see this as a channel line here. Okay, so this is within the channel, so it touches the upper channel line 3 times, 1, 2, and 3 times. Okay, so it moves nicely within the channel. So that's why I said that this is the foundation. The trend lines are the foundation before you even look at Fibonacci, before you even look at candlestick or whatever. You look at the trend first. From the trend, you know the big picture. So you know that this is the big picture. And if you can, right, usually I like to use this, the slope. Okay, this slope is about the same slope with this. Okay, so they are the same slope. And another thing, you need to count what? You need to count the number of candlesticks here. So for example, this upper trend here. Okay, upper trend, you can count the number of days of the up days. Okay, this is the going up, and then this is correction, retracement, and then this is going up, and then retracement, going up. So what we are going to do is to count the number of the duration of this uptrend. So this duration of the uptrend, you can count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 14. Okay, 14 will be the uptrend. Okay, then you see that you have down 1, 2, 3. Sorry, 1 and 2. 2 down day. Third is a down day. 3 down day, and then you follow by up 1, 2, 3 up day. Okay, down 3, up 3. So balance up. That means they are undecided, horizontal, because the number of days, right, tells you whether this trend is an uptrend or downtrend. So over here, down 3, up 3 is like horizontal, and then it says that 1, 2, 3, 4, 5, 6, 6. Okay, and then 6 down day. And then when you see the retracement, right, you see that the retracement is actually retrace a little bit from the top. And then over here, if you can apply Fibonacci, it will be good. So in fact, you see, when you look at candlestick, it's candlestick, but actually when you look at this chart, right, you have to apply quite a number of technical things, the basic things you must have, and then followed by the time cycle. This is what I call the time cycle, because I need to count the time frame of the up days and the down days, so that I know that it's actually on the up cycles. Okay, then I have to look at the retracement. How deep is the retracement? And this retracement usually will use Fibonacci. So there you see, it's a combination. Okay, it's a combination. But okay, so over here you can see that the retracement is using the Fibonacci, right? If you can use that, you can use. Otherwise, you can count manually. That means you take out a calculator and then you count the top here, what's the price, and then you calculate the retracement. The lowest price is here, so that means from the top to this retracement, it dropped how many percent? Okay, it dropped how many percent? Is it like 10% or less than that? So for Fibonacci, it's 382, which is 38.2%. Okay, so that's 1/3. So if you do not want to use Fibonacci, you use ratio, fine. Okay, you just use ratio and then you see what's the ratio. Is it 10%, 20%, 30% kind of a ratio? And the most important is the 50%. Make sure that it didn't retrace all the way down to the 50 and beyond. That's a big no-no. So that means what? That means that you are on the uptrend, nice and smooth uptrend. Then you retrace, which is normal. On any healthy market cycle, right? It will retrace and then you'll go up again. It will retrace, it will go up. So it's normal. But the thing is that you cannot retrace too much, okay? Because when you retrace too much, it tells you the psychology behind it's turning bad. You have a bad vibe behind it. You have a bad psychology behind it. So if you, let's say it turned like 50% or more, so that means that the retracement tells you that this chart here is weakening. Okay, it's weakening. However, if let's say you see that this retracement is like horizontal, it didn't retrace too much. It's like moving horizontally, and then it went all the way up again. So then, therefore, this kind of a horizontal retracement, it's a bullish strength that tells you. Okay, so then you count how many up days: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. In total, if you have more days, the duration of the up days is longer than the duration of the down days, you are fine. You are in a healthy bullish trend. But one day, your down day, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You have 10 down days. So you say, oh, something is wrong. Okay, I have 10 down days. Not as last time. Last time I have 3 down days or have, 4 down days. I have never have like 10 down days. So now I have 10 down days. So that means what? That means it's getting bearish. Okay, so it shows it's bearish, and then this low here is actually more than here. Okay, so here is a retracement here. So actually here the low is actually lower than the low. So you are getting a lower low over here. Okay, and then the high here is lower than the peak here. So you're getting a lower high and a lower low. Okay, so therefore over here, lower high with a lower low, by definition, is a downtrend. So you can actually draw a downtrend here, a downtrend here. Okay, it's a down channel line here. Okay, so actually by looking at the chart, okay, you incorporate. Okay, you don't look at the chart, candlestick chart pattern alone. You incorporate with the volume bar, the trend line, and then the Fibonacci, and then the time cycle. Okay, then it's a complete technical analysis. Okay, it's a complete. If you know some Elliott wave, you can apply also. But Elliott wave is very difficult to apply because it's usually when you're in the midst of it, you usually don't see it, and then when you're out of it, okay, when after some time over it, and then when you look back, then you see, okay, then I have to redraw it. It was not like that, but I have to redraw it. It's another situation. Okay, so anyway, it's not easy. Okay, but the more reliable ones are these are the more basic reliable ones. Okay, and then if I can erase this, I can erase. Okay, so you see this, another thing I want to see. Oops. Okay, I want to see that. I want to show you that you see that this volume bar. Okay, this volume bar is actually twice the height of the normal range. Okay, it's like a very ultra huge volume bar over here. Now, usually when you look at the chart, one glance you identify these high volume bar. Okay, the high volume bar you identify, you single them out, and then you try to look. You look back. You look back, and then you say, oh, it's this one. It's this candlestick that is doing like that. Okay, so then this candlestick, what you can do is that you look at the real body here. You look at the real body, and then you try to use that horizontal support and resistance line, and then you draw horizontal trend here. Okay, you draw across the horizontal trend, and then the real body is here, right? The tail you don't draw, you just draw the real body. Okay, now this, right? That means a lot of people are transacted around this price range, buy and sell in this price range. Okay, for this particular day, you have so many people buying and selling. Okay, now then you can use this candlestick, and then you draw the horizontal line, and then this horizontal line will be the support and resistance zone. You see the word zone. It's like a zone here. It's like a resistance zone here now. Okay, so that means the subsequent price, right? Because this is October. So the subsequent price, you may find that this particular zone is a very strong resistance because of this high price action, and then that this zone here will be a very strong resistance. So you may not be easily breaking through this price range. Okay, I don't know what price is that, but then this is difficult. If you can break it, it will go to another level. Okay, most likely you will test for a few times before you can break it. Okay, so most likely you'll find the resistance over here. Okay, so therefore, again, candlestick, you need to apply together with the volume, you need to apply with the trend line, and then you need to apply with the support and resistance zone. Then you can see something more. Okay, you cannot just see that candlestick as something by itself, individual. No, you can't. Okay, even if you to look at this situation, you see that this one is a very tall big tail over here. So if you look at this situation, it's a big tail because you were on top here. Okay, you are going up, running up to the top, and then you have the one down day, and then this down day is actually a hanging man. If you can zoom in, this down day is a narrow body here. If you can zoom in, it's actually a narrow body with a long tail, this one. And then subsequently, you have a longer body with a longer tail. Okay, this one. These two are very interesting. First, you have a hanging man. Okay, that means that although you have the hanging man, but there's a support because of the long tail. So, but anyway, it's a hanging man means a hanging man, that means a bearish, right? So the next day it was bearish. Okay, because people recognize it. So then they sell down. But the thing that this long tail also shows that you have a strong support. You have a very strong support. So that means what? That means although it's bearish, but still people still support it. So therefore, subsequently it went up. Okay, so it went up. So this one tells you about the psychology behind it. Okay. Going to the next one. Is it clear? Okay. Now this one, I got from investing.com also. Investing.com or okay, yeah, investing.com. So you have a chart like this. Okay, so a chart like this, and then you look at it. You have a gap up over here. Okay, now I slowly introduce more and more terms to you guys. So that's why I have to say that it's like everything, right? You cannot just look at candlestick as in candlestick. You have to look at more things. So in this case, it's a gap up. Okay, so gap up usually means that it's a bullish, okay, bullish situation, and then you have to measure the gap over here. So the gap here, if you can, you draw one horizontal line. Yeah, has to be that touches the body lah, but slant a bit. Okay, and then here, okay. Okay, so then you have this a gap here. So this acts as a support and resistance zone. In this case, it's a support. Okay, it's a support. So this gap will be a support. So you have to make sure that subsequently, the whatever price action here, it didn't fall back and close the gap. Okay, if you close the gap, it means what? You'll be downtrend all over again. Very bad. Okay, so the gap up is actually act as a cushion or support zone, so that the price will be up there. Okay, so then you have this a doji sign. Okay, so this one doji sign followed by a bullish white candlestick here. So these two combination here, they call it the bearish Harami cross. Okay, it's a bearish Harami cross, and then which means that this is like a Harami. Harami is a pregnant lady, right? It's a small baby inside it. So you see that this one is called a Harami cross, and then subsequently it's a down day. Okay, you still have another doji, and then followed by a large white, a large green. In this case, this green means black lah. Okay, large bearish candlestick over here. So this one is a bearish engulfing. Okay, it's a bearish engulfing, and then but with this bearish engulfing, right? But you see the subsequently you have you thought it's going to be bearish, but then subsequently you have a white candle. So that's why sometimes it didn't happen as it's supposed to be. Okay, it didn't happen when you think that it's going to be bearish, and just when you think that you're going to short it, then suddenly the subsequent day is a white candlestick. So what do? You have to quickly cut loss. I mean, close your position. You don't let the short continue, because this white candle is going to change the whole situation again. You see, it's like a baby inside this again. So it's like a bullish Harami. You see, then you have a bearish candlestick, and then followed by this white candle, smaller white candle inside, like a shorter on the next day. So it's like a bullish Harami. So it reverses. Okay, so that's why for candlestick, right, sometimes it didn't happen, and then you have to see what's the next one. If the next one see that it's a trend reversal, then the next day you will see that there's a gap out. So the gap out means that it's a confirmation. Then subsequently it will be all the way up. Okay, so okay, now important steps: draw trend lines, support and resistance line. Okay, and then you pay attention to any chart patterns formation. So number one, lay the basic foundation first. The foundation is that you draw the normal 20-day moving average, you draw the 200-day moving average, then you do it like automatic kind of thing. Okay, whenever you pull out your chart, you do this automatic. So, and then the next thing, you draw the horizontal support line. It's like you just do without thinking. Okay, it's like normal. It's a norm to you. It's a daily kind of thing to you. Draw. And then next thing, then you draw the trend line. Okay, you lay the foundation first, then only you look at the chart patterns. Try to see the macro picture, zoom out to see if there's any chart pattern, big chart pattern, and then you zoom in and then see what's the chart pattern. Okay, zoom out and zoom in. Whether you want to use daily chart, weekly chart, or whatever, it depends on what's your objective. If you want to go for bigger macro view, you can go for weekly chart, okay, or daily chart. And then if let's say you want to go for the daily kind of a trading activity, then you look into the hourly chart or minute chart or whatever, then that will be trading already. Okay, so it depends on what's your objective. So the time frame, it depends, but the basic is the same. Okay, you must, no matter if it's daily chart or hourly chart, the chart pattern, if there is a chart pattern, and then the price action will be subsequently. If you see a double top chart pattern, subsequently most likely you will see the neckline broken, and then you see a downtrend. Yeah, as simple as that. So the chart pattern is very, very important. Okay, you must see the chart pattern, and this chart pattern will give you the main trend. Okay, give you the main trend, and then only you look for the candlestick. The candlestick is a subsequent. Okay, that give you a secondary kind of a opinion or something. Okay, and then if it's a trend reversal, of course that's good. Okay, so you look at the chart pattern and then see that there's a double top, and then there's a downtrend, And then after the downtrend, you see a hammer, and then that hammer is a bullish candlestick reversal pattern. And then you know that it's end of the bear trend, and then the bull trend will continue, will start. Okay, so then look for the bullish and bearish chart patterns. Okay, so these are the main idea about chart, the candlestick analysis. Okay, I think we are coming to the Q&A session, and hopefully I can answer more questions. All right, so if you have any question, just yeah, type there, and then hopefully I
have 10+ minutes for Q&A. Okay, so if any question to ask Pauline, you may write down in the Q&A box. So we will address. Of course, there are so many questions on my screen right now, so we will just pick a few to ask. Okay, so very highly likely that we are not able to ask all of the questions. So yeah, just let me go through the question.
Okay, so ask those questions that are, you know, like how, or you know, don't ask about the terms. The terms you can always Google, but the how and why, and these are the questions that it's good to answer.
Let's say if you want to go for intraday trading, which time frame would you suggest?
Okay, my favorite depends on which one. Are you talking about equities or futures? Okay, usually for me, I trade the futures. I will go for the FKLI. Okay, I will go for the FKLI, and then I will go for the 5 minutes, 15 minutes, and then 30 minutes. Okay, 5, 15, and 30. So and then I will combine with 8 days moving average. Okay, so it could be a 15-minute chart, and then combine with the 8 days moving average, and then you see that somehow it wraps very well with the candlesticks. It wraps very well. Okay, and that's FKLI. So depends on what, and then you have to explore. You have to explore, and then if let's say you're talking about equity, right? Then you have to see individual stock. They have their own patterns, and then you have to explore whether which time frame is more suitable. Sometimes they may use hourly chart. Okay, so it depends.
Okay, so the next question is by Edwin. On which time frame do all these candlestick chart appear more reliable?
Time frame. Oh, I see. Okay, now for candlesticks, usually when people look at candlesticks, they look at short term, like 3 days, you know, or lesser. It's like if let's say you look at 5 days ago candlestick, it may not be useful because candlesticks are very short term. So usually for candlesticks, I use it weekly also. I use daily also. So hard to say. It depends on what's your objective. So if I want to look at the big picture, right, I may use weekly. Okay, like the other day I saw the Hartalega had a hanging man, and that was a weekly chart, and then it was a hanging man, and then subsequently there was a downtrend. So you know, could be a weekly or could be daily, depends on what you want. So there's no right or wrong, but then for chart candlesticks usually is for short term. The usage is usually for short term.
Okay, yeah, for the people asking whether you receive recording, how are you going to do the revision? Yes, you'll receive the recordings tomorrow, don't worry. So for people asking how to draw Fibonacci or Fibonacci related questions, don't worry, Pauline will have another session on Fibonacci, I think in December, if not
December.
mistaken, okay? Yeah,
December,
so stay tuned. Okay, so we'll skip all the Fibonacci questions. Yes, the next question is, do we look at VWAP when doing technical analysis? This is from Marcus. Yeah, VWAP, volume weighted average price, when doing technical analysis.
Volume weighted, sorry, volume?
This is from Marcus Chan. Volume weighted average price.
Oh, volume weighted average price. personally, I don't use this one, but if you want to use, also can, because it's a volume kind of a indicator. I usually look at the volume bar. So it depends on what is your, you know, your preference, because there are like a few hundreds of indicators, technical indicators. So you choose the indicators that you like, or you use the most comfortably. Okay, you use. So if this VWAP is what you very comfortable with, and then you find that it's quite reliable when you use together with the candlestick, by all means you go ahead. Okay, so yeah, personally I don't use this one, but if you use, then it's fine. Yeah.
Okay. Just give me a minute. I'm trying to digest what does this question mean. Okay, can you explain this hanging man? So the question is, why hanging man is a bearish sign, since there is a long shadow below, which refers to buying force that push up the price?
Yeah, because actually this is a bearish sign is because you are at the top of it. Okay, because you are at the top of it, and then you are having this kind of like a indecisiveness over there, like, you know, that day you have a selling pressure, and then at the end of it, then you have a strong support, but then this thing, but it happened at the top, so that's why it is a bearish reversal. But from my experience, right, I look at that, I feel that this one is not so like strength. Okay, so that's why I said that this kind of a bearish reversal pattern, I can only give like 2 star, but it's a famous candlestick pattern that everybody recognize, hanging man. So the effect will still be there. Okay, whenever you see a hanging man, sometimes you may see that the next day it may not happen, but if let's say you see that it happened, then the effect is still there. It's just that I would see that this one is not as more powerful as the shooting star. Okay, but nevertheless, it is classified as a bearish reversal pattern. It is classified. Okay, so yeah, so
Okay.
it's just the, yeah, it is, but then it's just that it's the strength is not there because of the strong support. You have such a long tail, but because it's found on the top there, so that's why you have such a big price action at the top. It's actually in doubt also. Psychologically, you have such a strong price action at the top there, it's actually in doubt. Okay, so that's why it is a reversal.
Okay, so how do we recognize fake breakouts? This right by Mei Ying.
Yeah. Okay, so that's why sometimes you need the trend line. If let's say you draw trend line as in okay, so if let's say this is a downtrend, okay, and then this is a downtrend, right? Then you are supposed to break out, and then you see that you have this hammer, right? So it's like, oh, definitely it's going to break out already because I have this strong support, and then it's a hammer. But the next day you have another like a doji. Okay, it's moving horizontally. So if let's say it's like that, and then sometimes and then it may, the next day maybe it break out, but then there's this 20-day moving average just on top of it, 20-day moving average. Okay, so that means you although you break out, right, but then you have this strong resistance, so maybe a few days later then it reverses back. So a lot of external factors will affect whether it will really have a true breakout. But usually when you see this one, you have to assume that it is a reversal, and then you have to do something. And then, but when the next day you do something and then it didn't happen, right, then you have to quickly salvage your mistake and then do something to reverse it. You cannot let it run. Okay, so that's why when you are in the trading mode, the candlesticks and everything, all this have to be very fast. You cannot let things happen and then you say, oh, what to do, just wait and see. The more you wait, the worse it will get. Okay, so you have to quickly do something. The minute you see that it is not like what you predict, you have to reverse it. You have to cut loss or something. Okay, so you have to see whether there's any resistance in the nearby vicinity, like 20-day moving average or the horizontal support resistance line, and then whether these are blocking the way. Otherwise, if all these are clear, maybe the chances of having a breakout is higher. Okay.
Okay, so the next question is by Hong Ui. What is the difference between spinning top and doji?
Okay, the spinning top is like a, you know, the gassing where you have this body, small body. You have this small body. Whereas the doji, don't have any body at all. You don't have any body at all. Okay, that means the opening price is the same as the closing price. This one, at least you have open low and close high, or open high and close low. At least you have a price difference between the open price and the closing price. But this one, no, it's the same price. But however, the psychology behind them, very similar, because both of these two have a long tail. So they are very similar. You can say that you can apply these two together, same kind of application together. These two representing the same thing, which means indecisiveness. It's just that one with the body, one with without the real body. Okay, but the meaning is the same. Okay, so you just focus on the psychology behind. Yeah.
Okay, so the next question is by Shazaruddin. Are the candlesticks similar to Heikin-ashi?
Sorry?
Are the candlesticks, right, similar with this Heikin-ashi?
Heikin-ashi, yeah. I'm not very familiar with this Heikin-ashi.
Because when you enable that function, right, the candlestick pattern will change one. They follow a different type of formation of the price action. Heikin-ashi.
Yeah.
You're not familiar, okay?
So Heikin-ashi is also like it's a pattern or what? It's an indicator. I'm not very familiar with this.
It is not an indicator. I will believe that it is a price action. I think I will classify under price action. Yeah. Okay. It's just like
so this one I'm not familiar.
The patterns a little bit special. All right, no issue. Let me just go to the next question. Let's do let's give a minute. Now, among the candlestick pattern that you're shown, right, Pauline?
Yeah.
How reliable? I mean, in terms of percentage, how do you say that? How high are the chances of it?
How high, right? I would say that if you want to compare like a trend line and all those chart pattern, right? Candlestick actually not very high. Okay, it's not like 100% kind of a thing. But then, but if you know, it's better than if you do not know. Okay, but those very familiar reversal chart pattern like the shooting star, okay, and also the hammer. All these, if you see this, right, because technical analysis is something like the more people know it, the more people will act on it. Okay, so it's self-fulfilling. Okay, so if you are looking at a candlestick chart pattern that everybody knows, so then this price action will be very highly reliable. That means that everybody look at it, they saw it, then they act on it. Just like the 20-day moving average. Okay, so if let's say everybody see that, oh, above the 20-day moving average is short-term bullish, below is short-term bearish. So if you can see it, everybody can see it, then everybody act on it. So above it, everybody buy, and then below it, everybody sell. So this will actually make this whole thing more convincing. Okay, so it's actually depends on the candlestick, because there are so many of them. So it depends on how common those patterns are. Okay, that's number one. And also number two is because candlestick chart pattern, like I said, is short term. It's like you can look at it as a 1 to 3 days kind of a price action. So you cannot take too much of a emphasis on the candlestick chart pattern, because it's like 1 to 3 days kind of a chart pattern. So you have to be looking at the big picture and then looking at the micro view, and then you will have to use together with the volume, trend line, and any other thing. Okay, you cannot rely totally on the candlestick. Definitely no. Okay, otherwise no.
Yeah, all right. So thank you so much, Pauline, for helping us to do the question and answer. Yeah, so today you have learned more about candlestick patterns. Now, candlestick pattern is definitely an indicator that is a leading technical indicators that can possibly tell you where could be the turning points, or is there a reversal pattern, or is there a continuation patterns. So personally, right, if I look at the charts, I will also look at candlestick. But then, like what Pauline said, I will look at the big picture, look at the trend line, and see because sometimes the chart patterns is a lagging indicator that tell us what, because the pattern is already completed. So but candlestick is a new patterns that show up that will tell us the what they'll probably forecast what will come next. So obviously a leading indicator will have higher chance of wrong signal, whereby a lagging indicator will have a higher chance of an accurate signal. So you have to, I mean, from my personal experience, we got to look at everything. I mean, look at the big picture, look at the lagging indicators, and potentially you can draw some information from the leading indicators such as candlestick patterns. All right, so right now let me tell you more about our next webinar, which is risk and money management strategy for maximizing trading results. So this will be conducted by David Lowe. So it will be happening on the 5th of November, Thursday, so 8:30 to 10 o'clock. So I have already put the registration link to you, so you may register it right now if of course you don't want to miss out. So quickly register it for these sessions. All right, so of course we also have a post-webinar survey. So long that you do our survey, you'll be in the running to walk away with a touch and go e-wallet pin worth 50 ringgit. So we'll pick 6 lucky winners to win. I would think that there are already quite a number of you already won this, touch and go e-wallet pin. So help to answer survey, then you will stand a chance to win. So not only you come to our webinar free, right, you can also walk away with some money. Okay, so this survey will be launched after this webinar and will also be sent to you via email. So lucky winners will be reached out within a week. All right, so don't forget to help us to fill up this survey so we can take your input, okay, and do better next year. All right, so thank you very much, everybody, for tuning in, and also thank Pauline for spending your time with us to share with us how you use candlestick charts to make trading decisions. So not only candlestick chart works in a futures market, but it can also work in any other market so long that got charts. All right, so thank you, Pauline.
Okay, welcome. See you, everyone.
Yeah,
thank you.
See you everybody. So Pauline still have 1 or 2 sessions coming up next in the next 2 months. So if you want to hear more from her, so can stay tuned for our emails for her subsequent sessions. With that, this is Shen Chu signing off. Bye bye everybody. Have a pleasant rest of the day.
Okay, bye bye.